Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Brian Leni, and we're going to be talking about how he is analyzing resource stocks, especially the precious metal stocks, in this environment of broadly higher prices. Brian is the founder and editor of the Junior Stock Review, also has the Premium Junior Stock Review, where he shares details on the companies that he's doing research on and the companies he is investing in. Brian, because you do so much research on these more advanced assets, one with economic studies, either PEAs or P feasibility studies, the whole way up the food chain, look, we're in this environment of higher prices. So, how much are you updating your models, and how much do these higher prices filter into your current research on, especially on precious metals companies?
Well, thanks for having me, guys. Yeah, when you're in this rising metal price environment, I think you can definitely start using higher and higher metal prices in your analysis. For me, for instance, and I'll go by how I've been structuring the premium portfolio. The recommendations I made in the first half of the year were back at the metal price back then at $2,400 gold. And obviously today, I think in the futures market, we've hit over 2,700 overnight. And I guess, definitely people have the inclination to want to jump ahead and start rising target prices. But I like to see the gold price, like I'll do analysis at the current gold price, but I like to see it stay there for 3 or 4 months before I use that as an acceptable level in terms of price targets. So for today, I'm fully comfortable with using 2,400. We saw gold hover there for a number of months, and we've seen it move up now. And I think all of the criteria for seeing gold stabilize, even at this price, is there. Record levels of debt, the pivot by the Federal Reserve, and the overall sort of theme across the world with recession or whatever we might be headed for, to me says that gold should be able to hold these levels. So probably looking into the new year, I'll look to raise price targets if we stay in this sort of level, but it goes with any other price or any other type of company I hold, whether it's nickel, copper. It's the same sort of process I go through in terms of what prices I use in my models.
Well, Brian, I think you do a fantastic job of being realistic when you're doing modeling. And I think you're one of the best out there at modeling development stage companies that I have seen from any newsletter writer. So tip my hat to you there. I follow along with your work personally because of that, because I think you're fair. And we were talking off mic about you use a 10% discount on the net present value versus the industry standard of 5. I asked you, should we start using 8 as an industry? And you said, no, we should be using 10. Maybe break that down for people, because, the cost of capital for these companies, if they want to build a project, is not 5%.
Sure. And thank you for those kind compliments, Shad. So in a DCF is a discounted cash flow model. So you look at basically what a potential mine will create cash flow to create in a year, and you base that off into the future. And as you have cash flows into the future, you discount it. And so a 5% discount definitely means that you're discounting the cash flow by 5% every year consecutively out for the life of the mine. Very rarely, I don't think actually at all today in the high interest rate environment, would you ever see a mine constructed for the debt portion to be 5%. What we've seen in the past, G Mining, the debt portion of their package was around 9%. Of course, they had a royalty and they had an equity portion to that too. But I think you're very lucky to get something under 10%. And so the idea is if you're losing 10% of the value of your money each year, that's what you look at the discounted cash flow. So for me, the 5% is great for a company presentation. It's usually a nice big number and captures investors' attention. But the reality of what it would take to construct a mine and how the money is devaluing over time, I think 10% is a much better view or realistic view of what the profitability for that company is going to be moving forward at this present moment. The other side, not only the cost of capital, but then you've got expenses. So inside your DCF, you've got the regular construction and the G&A of the operating mine. But don't forget, a lot of these juniors still have G&A spent on the junior itself. And a lot of these cases, when companies get to the PEA, PFS, and FS levels, they're spending upwards, let's say, $400,000 to $500,000 a month or a quarter. And so their burn rate could be up between $5 and $10 million. And so if that corporate side is going to be a part of the mining operation into the future, you got to account for that in the DCF. And I think that's what a lot of people forget. So long story short is that I think 10% is the only thing that really captures that cost of capital against the company's cash flows. And for me, it gives me that baseline margin of safety that I like to see before investing in a company.
How much safety do you like to see? Because quite frankly, run any project numbers at current metals prices, these things are going to be making money. They're going to be making money at different rates, though, depending on how variable some of their deposits are. So what is the margin of safety you're looking for?
It really depends on the quality of the project. We were talking off mic about the different qualities of or ranges of companies and how really, like, I would say the best of the best in the precious metal space are probably fairly valued, if not some of them with a premium. So although there's a disconnect between the equities and the overall metal price, I would say the best of the best really are selling probably where they should be. So you're taking a step down from there to find the companies that are selling at a discount or a larger discount. And again, they range. And for me, if you can find that, the top companies are the 1A, I want to find the 1Bs. And the 1Bs, I can accept, if let's say they've got a PFS and they're selling for, let's say, between 10 and 15% of that overall MPV at a PFS level. And so if they're selling within that range, and I think that, typically a PFS, if it's a good quality project and management team, it probably should be selling closer to 30. And so you look at a double there, but then you also look at a rising metal price and maybe exploration upside. And then those, that to me is like a perfect situation. So there's much more than just the discount to the underlying value of the project. You got those other intangibles that sort of go with it. And then of course, jurisdiction and location, how, let's say it's a 4 million ounce deposit and then they're going to look at producing 200,000 ounces a year with that potential mine in the future. Well, a senior mining or a mid-tier mining company is probably going to take a look at that, especially if it's in, one of the deemed better jurisdictions, as opposed to, let's say, 200,000 ounces of production in a questionable jurisdiction. So, you've got the discount to the underlying value of the project, but then you've got those intangibles, and those definitely massage the potential in that project and the margin of safety that I'm looking for. If it's located in some of the bad parts of the world, maybe the harder parts of Africa, some parts of South America, it's got to be a lot more of a discount than the projects that you see maybe in North America or some of the better perceived jurisdictions.
Brian, I'd like to get your thoughts on how you would value copper companies compared to gold, because the discounted cash flow method usually looks out 10 years. But when you're talking about copper mines, I was talking with George Ogilvy from Arizona Sonoran, and they were talking about having a 31-year mine life, but they think they could expand it even further to 35 or 40. And I said, you're not going to get a lot of credit for that. I said this to him off mic because of the way the companies are valued for 10 years. But with copper companies, these are decade-long projects. And I think sometimes this gets missed when people just pick apart the economic studies and poo-poo the IRRs and the NPVs. How do you do copper projects? Do you do them differently than gold projects?
No, it's the same process, but you're absolutely right that a company spending money to expand basically past 20 years, I would say, or even 25, there's no value in that, no value creation, because the discount, especially if you're using 10%, once you get past 15 or 20 years, like those years are worth nothing. So if you're spending $10 million to increase your mine life past that, you're crazy. Now, if it comes up, like if you get some of these porphyry deposits and you start drilling 200 and 300 meter intercepts and you accumulate 30 years worth of production with your initial drill program, or let's say your initial couple of years of drilling, it makes total sense. But to try to expand outside of that spent money, all that is probably to drive headlines and to catch more market attention from maybe the naive.
Well, what about the larger producers, though, Brian? Because the larger producers that would take over the project do want to see that 3-decade, 4-decade. That was the kind of the rationale behind it.
Right. And so to me, let's I'll use the gold deposit example. So, you have a deposit that's at surface down to 300 meters. You drop a couple holes that look at the 500 and 600 meter extension. You prove that it extends down dip, and that's all you need to do. But you'll see a lot of companies maybe put $10 million into the down dip extension for what? You're not going to get that value back. And I can actually think of a couple companies off the top of my head that fit that model, that are drilling down dip, but the money they're spending on their drill program won't justify the value they're going to get recognized by the market. And in some cases, it's just because of where they are in development. And in other cases, it's because of what you're talking about, where the discount cash flow model basically eliminates the value of those because they're too far out into the future. The other side to it is, I think, copper and the base metals are different because you want to see long life. Precious metals and base metals are completely different from my perspective. Gold and silver is money. And as such, I think it's going to be treated more and more as that. And so the commodity cycles, while they happen, the reasons for investing, I think, are a lot different. The base metals need these, let's say 20, 30, 40-year lifespans because the volatility in the cycle is, follows the business cycle. And the company doesn't want to take a 10-year bet. They want to take a 30-year bet because they're probably going to be right over 30 years and they're going to be wrong in amongst those. So you want to see long life out of your base metal projects, even though those 30-year lifespans don't necessarily make sense from a discounted cash flow model perspective. So depending on where that company is, how they're going to spend the money and what that means to the underlying project and who might buy them is sort of the puzzle you have to put together. But this is why, probably the average retail investor maybe doesn't put this all together because there's a lot of pieces to it. It's how you put that puzzle together that says, okay, well, this is viable, but this isn't. And why stock picking is tough to do. But the base metal projects are totally different. And talking about internal rate of return and how that reflects, these projects are usually billion-dollar projects, not like the gold projects, which are probably sub-billion when they're on the smaller side. These are billion-dollar projects that take huge upfront capital, and they need those large lifespans to make them make any sense from numerous perspectives. But the company, if you're talking about Arizona Sonora, it has to make sense for them to spend the money, like let's say a big chunk of money to show extendability. You shouldn't, in my view, just go out there and spend 10 to 20 million bucks to grab that resource that expands it. Just show that you can do it. To me, is better money spent. But each story is going to be sort of different. And that's kind of how I deal with it.
Oh, and that's keeping that blue sky on the table, right? Just show that there's something down there, but don't worry about drilling it off because that costs too much money. So, Brian, when you're looking at all these advanced stage assets, they're not all going to be built. Is your investment thesis around what will be built, what will be taken over, or what the current owner of the company can do if it's not taking it into production, but somehow adding value to that asset?
I'm definitely looking at basically all three of those things that you described. And really, it's the value proposition of each one, which one I think is more probabilistic given the management team and what I see from the project itself. So I'm looking at all three. And to me, there's a time in the market for each one. I think it can be hard to sort of differentiate between which is definitely going to get constructed this cycle and what's going to be acquired. What we saw in the prior cycle, and I only caught the tail end of this in my investing career, but we started seeing ounces added to balance sheets just to add them. Now, I don't think we're at that part of this cycle. I think you still want to stick to the best of the best, but there will come a time where valuations, I think, of the mediocre stuff that's probably not going to get built, it's going to go up too. And that's going to be in relation to however the senior mining companies are acting. And it probably will be when the gold price is soaring, kind of at that top of the market. And they're just trying to add ounces because the general investor out there is just doing a number of basically market cap divided by ounces and making a decision from there. But that's when you'll know you're at a top. So again, you stick to the higher end projects, whether they can get constructed or not, it's hard to say. But I think if you try to pick those higher quality projects, and they should stick out to you, you'll do just fine in this coming market.
Yeah, but let's get back to that market where we do see companies trying to grow just for the sake of growth, because I do think that adds a little bit of a whole new dynamic for other investors to come in. We all know that's not sustainable, but it is one of those aspects that this sector has really lacked over the last decade. We're not at that stage of this market yet. Brian, thank you very much for your time. Again, Brian Leni, founder and editor of the Junior Stock Review. Click the link in the show notes to check out his website and consider signing up for his premium service. Brian, thank you, as always, for your time. We'll chat again next month.
Thanks for having me, guys.